Welcome to Quartz Smart Investing. I'm Merrill Brown. Our guest today is David Bahnsen, founder, managing partner, and chief investment officer at the Bahnsen Group. David, thanks for joining us.
Thanks for having me.
There's reason for skepticism in your view about the markets as we move through September and into the fourth quarter. What concerns you?
I think it's mostly valuation. I think that it's one thing to have economic uncertainty. Some people can be concerned about some of the headwinds that are out there, but it's another thing to have it when you're already trading over 20 times earnings on the S&P. It just means that there's little upside and potentially more downside.
And there are structural changes going on that you write about and speak about often in the economy that you think investors often miss or overlook because of the moment's ups and downs. What are those changes that so interest you?
I think this is much more than a 1 quarter or 2 quarter story. It could be a 1 or 2 decade story, which is that economic growth has been really subpar. And this is for 15 years now. And I think a lot of investors are still expecting the same growth rates we had in the 80s and 90s, and therefore buying growth stocks that they think will meet that moment. In reality, I think it's much more of a value decade. You want companies that are reasonably priced, that are generating great free cash flow. That's what I expect to be the story for years to come.
And you're not expecting much from the Fed over the coming few months. There's an opportunity in September and one again in November for the Fed to move markets. What's your view and why?
I'm almost certain they won't touch rates in the September meeting, and I will be surprised if they touch them in the November meeting. And then going into next year, I just simply don't believe that they will be hiking rates in an election year. I do think they'll end up cutting. I don't know if it'll be right at the beginning of the year, but certainly at some point into 24, I think rate cuts are on the horizon. But it's very important for people to realize that if they do nothing at all, that's not a neutral position. Staying where we are is very tight. It's still extracting liquidity and extracting activity from the economy at this high of a Fed funds rate. You have a lot of borrowers that had originally financed at 2-3%. Now they're financing at much higher rates. That is a form of tightening, even if they do nothing.
And what does that mean for investors?
Well, it means that you can't expect to get a big lift from the Fed by them dropping the Fed funds rate a few hundred basis points and pushing valuations of, let's say, technology companies. Amazon trading at 100 times earnings. It's not going to 150 times earnings. Even Apple at 30 times earnings. The Fed isn't going to be giving you a lift that enables valuations to go much higher. And that's really what investors were used to getting. The Fed bringing rates to zero and valuations of stocks going higher and higher.
Next, David Bahnsen on why investors should be leery of stocks he calls bright, shiny objects.